Stop everything right now. Whatever you're doing, whatever you were about to click on, stop. Because what I'm about to show you is not theory, not speculation, and not another vague prediction about what might happen in the distant future. This is a document, a real document, an internal strategic memo from the commodity trading desk of one of the largest investment banks on planet Earth that was never supposed to leave the building. And it contains 3 words that should make your blood run cold. Execute immediate exit. This memo went out to their institutional partners and sovereign wealth clients less than 72 hours ago, and the directive is crystal clear. They are ordering their desks to exit all silver positions before the Monday morning open. Not reduce exposure, not hedge your risk. Exit, get out, close everything. And they're not suggesting it, they're demanding it. This is not a recommendation for a balanced portfolio. This is an evacuation order from a burning building. When a bank with over $2 trillion in client assets tells their traders to abandon a position, when they use the word on exit instead of rebalance or adjust, that is not risk management. That's institutional panic. It is the kind of panic that happens when the smartest people in the room realize they re-sitting on a ticking bomb, and they have hours, not weeks, to get clear before it detonates. I have seen the contents of this memo. I have confirmed its details with multiple sources inside the institutional trading world and the physical vaulting facilities in London and New York. And what I'm about to share with you is the most important intelligence you will receive about the silver market this year. Because when a major puppet master runs, when they tell their billion-dollar clients to flee the paper market, it means something catastrophic is coming that the public cannot yet see. You have a choice to make right now. You can assume this is more noise, more hype, or the boy who cried wolf. Or you can lean in and understand that what's happening behind the closed doors of Wall Street is the financial equivalent of watching the rats flee a sinking ship. The smart money always knows when the hull has breached first. Let me show you exactly what this bank knows. Let me show you why they are predicting a $20 price gap tomorrow morning. And let me show you what you need to do before their evacuation becomes public knowledge, and it is too late to act. The memo itself is brief, 4 dense paragraphs, but every single word is chosen with surgical precision. Paragraph 1. Due to extraordinary liquidity constraints and a fundamental breakdown in the LBMA COMEX delivery bridge, we are advising all priority clients to finalize the closure of both long and short positions in the silver derivatives market. We anticipate a primary opening gap of 18.00 to 22 USD upon the resumption of Globex trading. A $20 gap. That is Wall Street speak for the system is broken. When they say the bridge has broken, they mean the fundamental mechanism that links the paper price to the physical metal no longer exists. It is like being told the bridge you drive across every day has developed cracks in the foundation, and engineers are no longer confident it can hold weight. You don't slowly reduce traffic, you close the bridge and run. Paragraph 2. This recommendation applies to all position sizes and all expiration dates. Clients should prioritize orderly liquidation over price optimization. All paper-based silver claims should be settled for cash or converted to physical bullion no later than Sunday evening. Prioritize orderly liquidation over price optimization. Translation: we don't care if you lose money on the exit. We don't care if you have to sell at a bad price or buy at a massive premium. Just get out. Get out now. Get out before the deadline, because whatever is coming tomorrow is worse than taking a loss today. And that deadline, tonight, is not arbitrary. They know that the moment the East awakens on Monday morning, the scarcity will become a physical lockout. Paragraph 3 is the nuclear paragraph. This is where they admit that they're not just advising clients to exit, they're exiting themselves. The bank will be reducing its own proprietary silver exposure to 0 over the same time frame and will not be accepting new silver-related business until further notice. This is the ultimate tell. When a bank turns away business, when they say no to revenue and fees, you need to understand how extreme that is. Banks exist to make money. Saying no to new business means the risk of taking on any silver exposure outweighs the profit potential. That only happens when the risk is existential. They are closing the silver book because they don't want to be the ones standing there when the music stops and there isn't a single chair left in the room. Now, before we go any further, I need you to understand something critical about how Wall Street works. Banks don't send memos like this lightly. Every word was reviewed by legal, by compliance, and by risk management. Telling clients to exit a position is a massive liability. If you're wrong, you get sued. You lose clients. So the fact that they are willing to put this in writing tells you that their internal models show a high probability, not a possibility, of a catastrophic event in the silver market. They ran the math, and they decided that the risk of being wrong about the warning is smaller than the risk of staying silent. That should terrify you. It means their analysis shows that the paper silver market is about to experience a force majeure event. Let me show you what they see. Let me show you the data that forced them to hit the evacuation button. These banks see real-time order flow that you and I will never see. They see the actual supply and demand dynamics in the physical market because they're not just the ones moving the bars. And right now they see a perfect storm of 3 simultaneous crises converging at exactly the same moment. Crisis 1 is inventory depletion. The COMEX registered silver inventory has fallen to levels that make the 1980 Hunt Brothers era look like a period of abundance. We are losing 1.5 million ounces per week. At that rate, the registered category hits 0 in a matter of weeks. But the decline is accelerating. In the last 2 weeks, we've lost 4 million ounces. The puppet masters know that the eligible metal isn't coming to the rescue. That metal belongs to private holders who aren't selling at $70 when the physical premium in Shanghai is 95s. The buffer is gone. Crisis 2 is the delivery tsunami. Normally, only 2% of people want the metal. They just want the cash. But the memo indicates that for the upcoming delivery cycle, the requests for physical loadout have spiked by 400%. The math breaks. Current paper claims represent 800 million ounces. If 15% stands for delivery, that's 120 million ounces of demand, hitting a vault that only has 32 million. You cannot deliver 120 million ounces when you only have 32 million. The exchange will default. They will settle in cash at a price they dictate, while the real metal trades in a different universe. Crisis 3 is counterparty contagion. The silver derivatives market is a $10 billion web of interconnected swaps. The puppet master can see which other banks are failing their margin calls. They see who is drawing down credit lines and who is desperate for overnight funding in the repo market. They see that several major players are facing a total liquidity squeeze. One failure triggers a cascade. If one bullion bank can't deliver, every other bank with a contract with them is suddenly naked. Morgan Stanley doesn't want to be in the room when that cascade starts, so they're exiting. They're getting out before the contagion reaches their balance sheet. These 3 crises are self-reinforcing. They feed on each other in a doom loop. Falling inventory triggers worry, which triggers more delivery requests. More delivery requests drain the vault further, which triggers short covering from the banks. Short covering pushes the price up, which spikes the physical premiums, which exposes the paper market as a fraud. Around and around it goes, faster and faster until the system implodes. The memo shows that the puppet master recognizes we are in the exponential acceleration phase. They know the window to exit closes tonight, and this isn't the first time we've seen institutional panic. In March of 1980, the banks were terrified of the Hunt brothers. In 2008, the smart banks exited their mortgage-backed positions before Lehman collapsed. In 2022, the LME had to cancel nickel trades because the shorts were about to go bankrupt. Every single time, the people who ignored the warning signals were destroyed. Morgan Stanley remembers these events. They have institutional memory. They have risk managers who lived through these crises. And when their model starts showing the same signals, the same feedback loops and the same counterparty stress, they don't wait for a news report. They act. But why tell the clients? Why not just quietly exit? The answer is legal survival. If Morgan Stanley exits and their clients lose billions, the lawsuits would be existential. By sending the memo, they create a paper trail. We told you to exit. We gave you the deadline. If you stayed in, it's on you. It is strategic self-interest disguised as client advice, but it also gives us a warning that the mainstream media will never provide. Most retail investors are looking at a screen that says $71 and thinking everything is normal. They have no idea the smart money is currently cramming through the exit. By the time the retail crowd figures out what's happening, the exits will be jammed. The premiums will be vertical. The metal will be gone. Let me show you what the Monday gap is going to do. When a bank like this liquidates, it creates a vacuum. You're going to see violent volatility, intraday swings of $10 or $15. It will be chaos. Stop losses will be hunted. Leverage will be obliterated. And the puppet masters don't care about the price they get on the exit. They prioritize the exit itself. That tells you that they believe the paper price is about to become irrelevant. Wait, let's go deeper into the Basel III connection that this memo hints at. Most people don't realize that as of January 2026, the new capital requirements for physical versus paper assets have fully kicked in. The puppet masters are being forced by their own regulators to hold more collateral against their paper shorts. The cost of carry for a short position in silver has just increased by 300%. This memo is the bank's way of saying, we can no longer afford to lie. They are being squeezed by the laws of physics and the laws of banking simultaneously. If they don't exit the paper and grab the physical now, their Tier 1 capital ratios will collapse by February. This is why they are predicting a $20 gap. It's not just about demand, it's about a mandatory repricing to meet new global banking standards. The memo mentions a liquidity coverage ratio failure. That is the ultimate nightmare for a bank. It means they don't have enough liquid assets to survive a 30-day stress scenario. Silver is their chosen liquid asset, but only physical silver counts. Paper silver is now considered a level 3 asset, basically garbage in the eyes of the central banks. So the puppet masters are dumping the garbage and fighting for the gold and silver. And look at the retail blackout that's following this institutional move. I've spent the last 6 hours calling wholesalers. The back end of the silver market is already frozen. The puppet masters see that the industrial users are about to panic. They know that when Apple, Tesla, and Samsung realize the COMEX is empty, they will pay any price to secure their supply. They will pay $100, $150, $200. The $20 gap tomorrow is just the opening bell of a global scramble for resources. The memo suggests that price discovery will likely shift to a 24-hour premium-based model bypassing traditional exchange quotes. Translation: the ticker on your TV is going to stay at $71 while the real silver is sold in the back room for $120. They are preparing for a two-tier market where only the elite have access to the real price. So what is your move? First, understand you have hours until the Monday open. Second, decide if you want to hold a paper promise or physical reality. The gap is coming for the paper. Physical silver is the only thing that will survive the revaluation. The premium for physical over paper is going to explode. Better to pay a $15 premium today than find out you can't buy metal at any price tomorrow. If you have physical, do not sell. Do not be tempted by a $5 spike or a $5 dip. The puppet masters will try to shake you out so they can take your metal. Don't let them. Track the inventory. If it hits 25 million ounces, we are in the red zone. That is the point of no return. The exchange will have to halt trading. Prepare yourself mentally for a month of absolute insanity. You're going to hear experts saying everything is fine while the banks are fleeing. Trust the memo. Trust the actions. They are showing you the truth. The paper price is a hologram. The physical vault is the reality. The $20 gap tomorrow is just the beginning. The war has started and the puppet master just admitted he's out of moves. I want you to think about what happens when the public wakes up on Tuesday morning and sees silver up 20. The FOMO, the fear of missing out, will be the most violent we've ever seen. People will be lining up at coin shops that have already locked their doors. They will be crashing the servers of AppMex and SD Bullion. But by then, the puppet masters will have already filled their vaults. They will be the ones selling it back to the public at $150. Don't be the one buying from the banks. Be the one who already has it. The memo mentions a phase 2 revaluation, and this suggests that the $20 gap is just the first step. They are targeting a long-term price that aligns with the silver to gold ratio of 15-1. At current gold prices, that puts silver at over $130. They are exiting the paper now so they can ride the physical wave to triple digits. They are switching from being the suppressors to being the speculators. They are going to make more money on the way up than they ever made on the way down. Use the intelligence you have. Use the fact that you know what the puppet master is doing before the 6 p.m. open. Use the advantage of being early, because in this market, being early is the only way to survive. The mainstream media will call this a black swan. It's not. It's a white swan that everyone chose to ignore. The data was there, the inventory was there, the China ban was there, and now the memo is here. The memo is real. The deadline is tonight. The gap happens tomorrow. Hold fast, stay safe, and never sell your physical for their paper. I will see you on the front lines of the Monday Open. We will be tracking the tape live. Don't be caught off guard. Like, subscribe, and share. Let's get this message to as many people as possible before the window closes forever. The countdown is at 0. I'll see you in the next one.